But here in our first hour, I want to get into some of the problems that we have with our economy, and what can be done. The Washington Post today, Nicholas Brady, former Treasury Secretary in the Reagan administration, as I recall, Reagan administration, is coming out and saying, Barack Obama had an opportunity to truly reform. President Obama had an opportunity to truly reform the financial system. He had enormous political capital, still does. But in particular, in his first few months, enormous political capital. And instead of truly reforming the regulatory system for our banks, has taken only very tepid, small half measures. And, there's this big debate going on right now about what the future of the economy is going to be, how it's going to, whether we're in a W or a triple W or a or it's just a V. In other words, have we hit the bottom and it's coming up? Or have we hit a false bottom? It's going to go up a little bit, seems to be right now, and then it's going to go back down, even worse. And then maybe it's going to come up a little bit and go down even worse. That's what happened in the 1930s, by the way. And there are some who are suggesting that. RGE Monitor, by the way, is Nouriel Roubini's blog. You can find it over at rgemonitor.com. And they do a daily, I'm not sure it's daily, but they're a regular little news push. And I'm on their mailing list. And one of the things that they point out is that China, first of all, is looking at developing a new reserve currency. The BRIC countries, Brazil, Russia, India, and China, are talking about maybe a basket of currencies, but this isn't coming to pass, and in fact China's more limited than you might think, and so the possibility may be that they're just going to go with commodities, gold, for example. So we'll see what happens with that. But the big question for this hour is, did Goldman Sachs, one company, cause the crash of 1929 and the crash of 2008? And increasingly the evidence is yes. Matt Taibbi has written just an absolutely brilliant piece over in Rolling Stone, The Great American Bubble Machine. And if you haven't read it, I encourage you to run right out and get it. You can find it in the current issue of Rolling Stone. It's also on their website, of course, at rollingstone.com. And the subtitle just really says it all. He says, from tech stocks to high gas prices, Goldman Sachs has engineered every major market manipulation since the Great Depression, and they're about to do it again. Which ultimately, by the way, is going to bring us back to this cap and trade thing, which passed the House as a squeaker last week, and now has to go on to the Senate, where it's going to need 60 votes. Good luck. But Dennis Kucinich, Peter DeFazio, two members of the House of Representatives for whom I have tremendous respect. I put them in the Bernie Sanders category of high integrity, honest guys who tell the truth. Both voted against it. And they voted against it because they said, this is just another gift to Wall Street. And in fact, Goldman Sachs. Goldman Sachs is a company that's well over 100 years old. And in 1929, and by the way, my Buzz Flash book of the month from, as I recall, 3 months ago, maybe it was 2 months ago, in any case, a couple months ago, was by John Kenneth Galbraith, the famous economist who recently died. It was called The Great Crash, 1929. And it was originally written in the 1950s, and then he updated it back, about 8-9 years ago. And he was absolutely prescient in that book, predicting the next crash, which is why it's such a brilliant book. But there's an entire chapter in that book called In Goldman We Trust, about how Goldman Sachs basically did the great crash in 1929. And they did it through this series of shell companies. They basically, they created what they called the Goldman Sachs Trading Corporation, and they sold shares in this trading corp. It was back in that day, it was the equivalent of a mutual fund. You can buy into a mutual fund now, and it's like, somebody's managing a bunch of stuff. It was sold sort of like a mutual fund. And they sold their shares. They issued shares at $100 a piece, They bought all of their shares with their own money, and then they sold 90% of them at $104 each to the public. And the public snapped them up. So they made a profit on the initial sale of their own stock, of their own company. And then they started, since they kept 10% of the shares, they started buying back their own shares, which drove up the price of their shares. That company then spun off a new company called the Shenandoah Corporation, issuing millions of shares in that fund. And the Shenandoah Corporation then created another company called the Blue Ridge Corporation and issued millions of shares in that fund, and people all over America were buying these funds. And in fact, there's some people, those who are old enough to remember the Great Depression, I'm certainly not one of them. You'd have to go back to my grandfather for that, but people refer to that as the Shenandoah crash sometimes, or the Blue Ridge crash. I mean, this is, and as Matt Taibbi points out in this Rolling Stone piece, he says the Shenandoah eventually it dumped part of its holdings and sponsored a new trust, the Shenandoah Corporation, issuing millions, which in turn sponsored yet another trust called the Blue Ridge Corporation. In this way, each investment trust served as a front for an endless investment pyramid. Now, Bernie Madoff just minutes ago was convicted and sent to prison for 150 years for doing what essentially Goldman Sachs was doing in 1929. Goldman hiding behind Goldman, hiding behind Goldman. As Matt Taibbi says, of the 7,250,000 initial shares of Blue Ridge, 6,250,000 were actually owned by Shenandoah, which of course was in large part owned by Goldman. As John Kenneth Galbraith says in Goldman We Trust, in that thing, he says the trusts were the major cause of the market's historic crash. That bank suffered losses of $475 billion. He said, if there must be madness, it may be said that they had it on a heroic scale. Well, they did it again. In 1981, they got an exemption. And by the way, Matt lays out how they drove gasoline up to $4 a barrel. They were the ones, the oil, $140 a barrel. This was Goldman Sachs, in large part manipulating the oil industry. In 1991, they got an exemption from oversight over CFTCs, over these commodity trading, the Commodity Trading Futures Commission, over the commodities, which were originally designed to allow farmers to sell their corn before they planted it, so that they would know that they had a buyer. This goes back to the 30s. And they said, we want loopholes in this. They got them, and they used that to pump and dump oil, to build these oil bubbles. And in fact, it was a secret they even got it in 91 until just very recently as a result of a Freedom of Information Act filing. And so by 2008, he points out, at least 3/4 of all of the activity in the commodity trading wasn't people buying and selling commodities. It was speculative. It was people buying and selling paper that represented the option to buy and sell commodities. Which brings us to this whole cap and trade thing, where we're going to say 85% of these carbon credits we're going to give away, and these are going to become new commodities. A giant gift to Goldman Sachs. Well, who's behind all this? Right after the break.